Richard Harris is with us, uh, Executive Director at Port Shelter Investment Management. Richard, good to have you with us here. Thank you very much for your time. You know, the fact that there are three things. One is, let's just look at what the market is doing and whether we should read too much, whether we should interpret market moves to kind of, decipher what's really going on, if that makes sense. So the dollar's not moved higher sharply. There's no great demand for US treasuries, which both are considered safe havens. This is true yesterday. This is true the day before. And of course, look at oil prices. We've seen a bump, but should be, if this is a broader war, should be much higher. Is it telling us something, Richard?
Well, you would have thought it should be, because all of these things are moving as if this is just going to be a small skirmish and then finish. Now, we do know that any skirmish between Israel and Iran is not a small skirmish. It's really quite serious. I think the markets are sanguine because, in a sense, Israel made the first move, so therefore they may be considered the aggressor. They now appear to have control of the skies over Iran, which also enables them to cease fire when they want. It does look as if the Iranians maybe are running out of ways of retaliation. They've only launched a smaller number of missiles than they've done previously. So I think the market's basically saying this is going to be fairly short-lived. It's going to be something that maybe will pass by. And I think what they're doing is looking at what's happened in the past. We had Ukraine, which scared the markets, but then the markets got used to it. We had Gaza, scared the markets are used to it. And I think people are thinking this is just more of the same, rather than something more serious. My personal feeling is it is more serious, but we can come on to that in a minute.
So in that situation, what should one's investment strategy be? While it is a human crisis, people typically look at these uncertainties as reasons to go ahead and increase their allocation towards the equity markets. Would you suggest the same?
And well, it goes both ways, doesn't it, with this?
Yes. So what would your investment strategy in a situation like this then be?
Well, I think, and I'm quite serious, I'd put on a hard hat and sit on my hands. My feeling has been, certainly since the Trump tariffs came in, is to have very conservative portfolios. Yes, I still like tech stocks, but I've reduced my weightings. I've spread my weightings slightly out of the US into other markets like China, like Europe, which have underperformed. And I've also raised some cash. So I think being in that position, I'm happy to sit on my hands. But I do think that the picture doesn't look particularly good. We've got Trump leaving the G7 meeting early for reasons he hasn't disclosed. It's very difficult to believe anything coming out of Trump's social because it changes so often. So we don't really know what's happening. But my feeling is have a fairly conservative portfolio, sit on your hands and just wait until something real comes along, some real news that does make a big change to the market view.
All right. Hi, Richard. Good morning. Good to see you, Ben. Nigel on this side. Richard, I wanted to ask you, but what about the Indian markets? The hope that I have is that hopefully things clear out on the geopolitical front and the markets, continue tracking what central banks are doing, tracking earnings as well. Where does India fit into this, into your entire scheme of things? Do you think, like how you said a few months ago, that we'll be performing in line with global markets, or do you think we can outperform? I ask this in the backdrop. You have crude oil prices that's moved very, very swiftly up 10%, and still the Indian markets are unmoved. Normally, you would have seen, a few years ago, the Indian markets pull back, so showing some kind of resilience.
I think the markets are basically, they've got this comfortable attitude in. It's still the bear market move after all, and bear markets die hard. So I think, yes, oil's moving up, and people say, well, oil's moving up, but it's going to move down. Just prior to this skirmish, we had Saudi Arabia coming out looking to increase oil production, which would have put more pressure on the oil price. It looks as if there's no real influence on the oil price to move up. So I think markets are basically saying, well, it's probably not going to get much higher than this. It's likely to come off. In terms of where India fits into this whole pattern, I think it's the same thing, that it's likely to move at least in line with global markets, maybe even slight outperformance. But these aren't normal times. We're seeing a movement out of the US because the US has been a banker investment market. And the question is, where's that money going to go? Is it going to go into cash? Is it going to go into India, China, which I think is quite possible? Is it going to go into Europe, which I think is very possible? So there's a bit of a mixture. If you're betting on the upside, it's tough at the moment. That's why I'm sort of looking to have more conservative portfolios. But personally, I always like a proportion in India. And let's face it, over the last 5 years, it's been a fantastic investment.
Mangalam, to your point, I completely take that these kind of situations usually are opportunities, and market investors have treated it like that. But the point is, you've got to have that dip first.
Yep.
Right? I mean, markets have moved the other way, which is
Never waste a good crisis.
Yeah, but what I'm saying is the crisis has got to show up in prices first, right? To take advantage of the prices, lower prices. It's not happened yet, at least not from an equity market perspective. Richard, it's a blind one, but I don't know what. Do you think the US will join the fight? As a financial market person, I'm asking you.
I think not. No, I don't know. I mean, I think the game Trump is playing is a regime change game. Of course, the Iranians could say the same about the Americans. I think the only reason why America would get directly involved is if the Straits of Hormuz were blocked off. 20%, 25% of oil comes through those straits every day. They're very narrow. They could try and attack on there. I think they won't. It's not going to be successful. But I think that's the one situation where the Americans may come in directly.
Qualitatively, I just wanted to know.
There are some, and I don't know how much to go with it, but they're saying that, well, there are 3 fires detected in the Gulf of Oman, which is essentially the Strait of Hormuz. It's just, there's some tweets just now, 2 minutes, 3 minutes back. So we'll have to sort of get confirmation, but that is a big risk.
That is a big risk if that were to happen. But let's while we do know about the possible worries here, Richard, qualitatively, what would the signs be for you to start not becoming conservative?
Well, I think, as Prakash was saying a moment ago, you've got to have the pain before the gain. We're in a situation where markets are, close to their highs. Certainly, they're knocking around where Trump came in. But we've got these major issues to confront. Big tariffs on China, big general tariffs on the rest of the world, costs that are increasing. I was speaking to a steel trader yesterday, looking at exporting steel, well, trading around the world, but mainly from China elsewhere. It's very, very difficult to trade at the moment. And that price of steel is going to work its way right through the economy. So there are lots and lots of issues to come out there. What we've had recently is a whole series of little bits of good news that's pushed the market up. I'm actually waiting for that external shock that's going to hit these fragile markets and push the market down.
All right. We'll leave it there. Thank you very much, Richard. It's a pleasure having you here on the program. Thanks indeed
Thank you.
for those views. Well.